All right. Hello, hello. Oh, no, wait. Man, forgot to set something up. Dun, 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 dun. Hopefully somebody can hear me. Or hopefully nobody can hear me because I'm not ready. I'll be ready in a minute, though. Oh, people can hear me. Oh, well. So much for anonymity. How could begin? Yeah. What the hell? Uh-oh. All right. Hopefully this will get everything going. All right, let's see if we can get the video working. Okay, I think. Oh, yep, it went green. No, wrong thing. Hi, guys. That was totally the wrong button. Let's try that again. That was scary, right? Mitchell is criticizing my appearance. Really? I mean, come on. All right, so can you see the screen? That's the question, guys, not whether or not you can see my beautiful face. All right, people seem to be able to see the screen, so we are good to go. Let's see. Put that away and move that and go to this page and hit that button.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the website www.optionstrader.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold your above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right, fantastic. So how are things looking? Let's see. We had a little bit of a sell-off, bouncing back already, of course. Can't allow a sell-off to continue very long. I don't know why that's on such a long view, but that's interesting. I mean, so here we are. Oh, it's not a long view. What is this? For some reason, it's got all the hours in there. It's weird. I wonder why. 5 minute style. I don't know. That's pretty weird. Do I like it? I don't really like it. I don't think I like it better. Anyway, so I don't know why this one too. So these two are in this format and these two are in this format. But either way, obviously pretty sharp sell-off we had all of a sudden just recently, and now we're recovering. We did the gasoline thing today because gasoline was elevated. There was no particular reason that I didn't think 120 would hold. But, well, no, I'm sorry. Well, there was a reason. There was, the API report showed a fairly neutral balance between buying and selling. We noticed that earlier. And oil was shooting up and gasoline was shooting up. Where's oil? So oil shot up and gas shot up, and I didn't see a good justification for it. We were coming up to the 41 line. So I decided that'd be a good spot to short it. So we took a short on this thing. And as it crossed back below, we got a nice cross down and caught a good wave all the way down to 185 here and all the way back to 40.80 here. And that's a couple of $100. Well, it was $170 by the time it passed. It was a $200 drop here, and here was a $500 drop, even more than $500. So what else do you want from a morning? It's like, that's fine. You've got to take those quick profits and get out and get them off the table, because there is no real catalyst here. All I was saying was I was looking at the chart and I'm looking at where we were and I'm saying, was this move justified? And I didn't feel it was justified. So once it went up $1, it no longer was really, I felt that it was probably going to hit some resistance and at least pull back. So that's the same thing here. Once it went up here you went up from 116.5 to 1195, went up 3 cents. That's a big move for gasoline. And what kind of move is it? A 2.5% move. Just the old 5% rule, that's all. That's what the 5% rule is. And what's this move? 40 to 41 is how much? 2.5%. That's how you use the 5% rule, okay? It's a 2.5% move. It's going to get a pullback. How much of a pullback? 20% of the move is going to pull back. So if you move up $1, and again, you ignore the spikes and you ignore the spike on the upside too. If it's going to move up $1 from a consolidated $40 line, which made a good bottom, it had to move up. So it firmed up the bottom at 40, made a move up to 41, 2.5% at 1.25%, which would be 40.50. That's that. You see how it peaked down here before? See over here? So it did hit the 1.25% line, failed that, came back, so went up 1.25%, failed that line, consolidated for another move back up, punches over the 1.25% line, goes to the 2.5% line, and then how much is it going to be rejected? 20% of the $1 move. It's not a rejection. You say rejected, but it's not really rejection. It's only a retrace. So your initial retrace, a weak retrace, is 20%. 20% of the $1 move is 20 cents. When you make the trade, you know how far you expect it to fall. It would be surprising for it to do a strong retrace without a good reason. That's a strong retrace, a 40-cent move. That would be surprising. Not surprising at all. On the first attempt to get over the line, you almost expect a weak retrace of at least 20%. Once you get to the strong retrace, this whole thing may be failing. That's when you're going to watch it closely. But this is nothing. This is just part of a bullish pattern. It's going to consolidate. That's what the 5% rule is telling you. It's saying at this point, computer programs are going to click in. If there are selling programs, they're going to click in at this inflection point. If there are more buying programs, they'll click in at this inflection point. But you don't know until they activate whether the bus is. So the 5% rule doesn't tell you what's going to happen. It tells you where it's going to happen. It says something's going to happen here. But you know that the selling programs, in other words, there's buying programs that are taking it from here to here. For whatever reason, the things have lined up and enough buying programs have come online where they overwhelm the resistance of selling programs at this level. The buying programs are free to move to a certain extent, but when they hit the next 2.5% level, it gets progressively more likely they're going to run into resistance at 1.25, 2.5, and 5%. So when they get to the 2.5% level, they're going to encounter some pretty heavy resistance, especially on a very robustly traded index like the oil indexes. So the more things are traded, the more they're going to obey the smaller parts of the 5% rule, 2.5 and 1.25. Even an index like this, the S&P will obey 0.67. We'll go half of 1.25. It'll go down to 0.67, or 0.625. Yeah, 0.625. Anyhow, so where was I? So here's your 2.5% move. So what's happening here? Here is where you've got buying programs and selling programs in equilibrium. Something happens that causes more buying programs to kick in. No more selling programs kick in. Something positive happens. Probably the API report. See this 7:55? The API report happens, or I'm sorry, that's first thing in the morning. I apologize. It's not that. So something in the morning happened, whatever it was, and oil starts going up. So in other words, something causes more buying programs to kick in. The buying programs have not enough resistance. They've already broken the resistance here. They had already flatlined, so they broke down the resistance here. These selling programs basically have had enough already. Now there's some positive news, so it causes the algorithm to sell less. At the same time, new algorithms come in and start buying. That's going to take you up. And where's it going to take you up to? Well, there's a group that arbitrarily set their selling indicator here, but there's another group that arbitrarily set their selling indicator here. So until you run into the next line that is likely to have more programs kicking in, which is going to be the converging 5% lines, 2.5, 1.25, that's when you see if there's any real resistance from the new sellers. So the new sellers kick in here. They overwhelm the buyers. There are a good amount of new sellers. They overwhelm the buyers, and they're always going to cause resistance at that level. And as soon as they hit resistance, boom. And now another thing happens, though, because this is considered a very nice profit for somebody who was in a buy program. They're going to start doing profit taking as soon as they hit a retrace. So you get a quick retrace when the sell programs kick in, and then you start getting some profit taking, and you get a good amount of volume. See how the volume spikes up? Because then a lot of these guys took their profits off the table, and then things settle down, and now you get back to, are we going to find a point of equilibrium here? Just like the trip from 39, you can't see it, from 39 down here to 40, you had the same exact trip basically. Went up to 40, jiggled around 40 for a bit, and how much was the retrace from 40? Just a little bit above 39.80. And when you have a retrace and you don't quite get to your pullback spot, that means that it's a strong move. But if you get to your pullback spot, it means that you don't know what's going to happen next. It means it's iffy on whether you're going to keep going. I think we'll probably eventually go lower, but right now we're consolidating before move down. So I hope that helps. In gasoline, do we have the same thing? Sure. In gasoline, let's see if we can get a bigger picture. Okay, so here you can see we're consolidating around 118. And then further down, going forward, do we consolidate at 118? No, 118 is where, well, here became a top. So we consolidated around 118, got weaker, failed, went all the way down to 116.5. 117 held up nicely though as a bottom on the whole, other than this thing, which you ignore because it's only a spike down in the big picture. And then we went basically, so the real move here is from 117 to 120. That's 3 points. Okay, and 3 divided by 17, that's a big move. That's 17.6%. That's no, I did that wrong, right? 1-1, it's still 1-1. Oh, I'm sorry, haha. It's 3 divided by 117, because it went from 1.117 to 120. I'm sorry, so surprisingly, it's 2.5% again. That's where it was. So once again, we have a 2.5% move. So if 3 cents was a 2.5% move from 117 to 120, and we ignore the spike over, we ignore the unders, we just, that's from here to here is a 2.5% move. So how much of 3 cents is going to be the retrace? It's going to be 20% of 3 cents, which is 0.6 cents. So that means we're going to pull back to 1.196. No, 1.194. Sorry, 0.6 cent pullback is going to take you to 1.94. And that's frankly exactly where we are. There's the 1.194 line. And you can see what happened. We went to 120. We have a pullback, and then a strong pullback is going to take you from 9.4 down another 0.3. So it's going to take you to 9.1. Is that right? 9.4? No, I'm sorry, not 9.1. 9.88. 8.9. Sorry. 8.9. No, wait. 8.8. Sorry. So 8.8. Good God, can't do math. All right. So here's your 8.8 line. So in other words, the 0.6 of a cent pullback, number one, takes you to 1194. Then another 0.6 below that is 1188. So this was a strong retrace we had on this one on the gasoline. That's why we made so much money. We made $5.71 on gasoline, because gasoline gave us a strong retrace all the way back down to here. And now it's bouncing back, and now we're going to retest. Well, we already blew past 9.4, so it's actually still on a strong move. But you have a weak retrace, then you have a strong retrace, and now you're coming back a little bit, and we'll see what happens. But it's no longer an easy bet. It's that first time that you test a new level, the first time you do a breakout, especially if there's not a particularly great reason for it, that's when you can count on something happening. So WBA, can you look at a position to buy the stock and sell the calls and puts around this? Looks low on the channel now. Yeah, but you see, that's the problem, is you can't just say, oh, I want to do this with WBA. You have to look at WBA and think to yourself, does that make sense? You know, you're kind of forcing a strategy, but the strategy is not necessarily valid. So let's take a look at WBA. So I like Walgreens. I think they're way undervalued. I think I'm not going to get into it again. I think almost every week we talk about how ridiculously undervalued Walgreens is. And the question is, can you buy the stock and sell calls? So do I want to buy the stock is a question. It's like, what are you buying it for? I don't think they pay a dividend. WBA, as far as I know, they stopped paying their dividend. Oh no, it says they're still paying it. Oh, all right. That's interesting. And the earnings are when? Earnings are on the 15th, which is tomorrow. Haha. All right, well, in that case, I would buy it. I'm sorry. So if they are paying their dividend, why not buy it, right? So you buy the stock for $35.81. And you know, we feel it's low in the channel. I mean, tomorrow's earnings, it's a little tricky, but if you're going to go for a long-term trade, it really doesn't matter. It's not a big deal that, you know, when you enter it or how you enter it. But WBA, so I wouldn't go too crazy with the puts, because you don't know, maybe earnings will be bad or something like that. But let's say you buy 500 shares for 35 bucks, which is like $17,500 ish. 17, if it was 36, it'd be 18. So let's say $18,000. So you buy 500 shares for $18,000. And then you have to say to yourself, well, what if earnings suck tomorrow? What if they drop 20%? Where's 20% going to be? It's going to be about 29 bucks, okay? Can you imagine anything so bad that they're going to go down to 29 bucks and stay there? Well, then you go back to your valuation and you say, well, you know, they're trading at, we went through this last week anyway. So they're pretty much trading at 10 times normal earnings. They're not having normal earnings now. But their normal earnings, if you are going to be, and under no circumstances is this a trade. This is a long-term investment. Income is usually $4 billion, and Walgreens is currently valued at $31 billion. So they're trading at below 10 times earnings. So if they drop 20% from here and the market cap becomes $25 billion, then $4 billion would give them a PE of roughly 6. So I would be very enthusiastically a buyer of Walgreens at $30. So in that case, I don't consider it a big risk to sell these puts. So if I can get $5.60 for those puts, so that means I'm buying my stock for $18,000. Okay, I'm going to sell 5, so I'll double down at 30, buying the stock for 36. If I sell these puts, the 30s, for 560, so that's minus 2,800 for selling 500 of those, right? So now I've knocked my cost down to 15,200 on the 500. And let's say we set a target. So you have to think to yourself, what's my target for Walgreens? Well, let's say, obviously they're taking a loss right now. They'll be lucky to make $1 billion next year. They're not going to make anything next year. So they're not going to go anywhere next year. 2 years from now, this is 2023 though. 2 years from now, they should make a couple of $1 billion in 2022 for sure, probably more. But let's say they only make $2 billion. So they make $2 billion in 2022. Still, they got to give them 15 times earnings. They should be $30 billion. So they still should be about this price at least, with a $30 billion valuation. They still should be above 30. But by 2023, clearly they should be recovering enough where it's going to be visible that they're going to be back on their 4 billion pace. And that way, even 10 times earnings, they should be at 40 billion. And that's going to be about 10% higher than they are now. So my target is going to be 10% higher than 36, which is just about 40. So conservatively, I don't want to go crazy. Get the calculator out. So conservatively, I don't want to go crazy, but I do think they'll be at 40. And the question is, do I want to collect $5 for the 40s, or $6 for the 3750s, or not even more than $7? So really, that's out of the question because it doesn't pay you even 7. So why would I do that? I'm not getting paid enough money to give up 250 in headroom that I'm fairly certain we're going to be higher than that number. But the question is, should I give up $1 in order to be this much higher, in order to be the 40s? And I say no, because frankly, I don't know how fast they're going to recover. They're in pretty bad shape right now, and I'd rather take the dollar now. I'd rather take my dollar now and either get called away or whatever in the future, but I'm not going to sit there and extend my bet and not collect the extra $500 just because I hope it's going to be over 40. I don't have a compelling reason for that argument. So my target of 37.5 is fine. So now we're going to sell 5 of these for $610. Hopefully, let's say 6. So then that's another $3,000. So then it's going to be minus $3,000. So now my net cost of 500 shares is $12,200. All right, so that's what we've now spent. It's $12,200 divided by 500 shares is we've now netted in for $24.40. We sold the $30 puts and the $37.50 calls. So what happens if I then end up selling, if I get called away at $37.50? We're going to make $13.10 times 500. We're going to make $6,550. We're going to make 50%, plus we get the dividend. But the dividend, since we're only laying out $12,000, that dividend becomes, I forgot what the dividend is, but it's good. The dividend is $2 basically. So 2 divided by 12. No, I'm sorry, it's not 2. It's not 12. It's 1,000. It's 1 divided by 12 because only 500 shares. So the dividend becomes 8.3%. So we're going to make 50% in 2 years, plus we're going to collect an 8.3% dividend. So it's like 25 plus 8 is 33. So we're going to end up making 33% per year on that very nice conservative trade. I love it. But that's how you do it. You just got to be sensible about it. It's like, we're only laying out $12,000. And what's your worst case, by the way? So your worst case is you end up getting assigned. So you have a $12,200 cost or whatever it was. Then plus, if you get assigned 500 more 30, it's $15,000 for 500 more. So that equals 27.2. And so obviously your net cost is $27.20 per share, not counting if you collect the dividends, it would knock off $4 more, right, for 2 years. So you'd be at $23.20 or 23, because there's some extra. So you'd be at like $23.20 for your base cost after collecting dividends over 2 years. So your worst case, and even if you say, oh, they cut the dividends or whatever and they don't pay it, you're still going to be at $27, which is $8 below 35. So you go 8 divided by 35, 22%. So you get a 23% discount basically. Your worst case, setting the trade up like that, is you're going to be in 1,000 shares of WBA for a 23% discount. That's the worst thing that can happen to you. Your net's going to be $27.50 way down here. If you sold the $27.50 calls, you'd be selling them for $11. So that's how unrealistic people think that is. So I like that trade a lot. That's a good trade, and because obviously, I mean, look, if you can set up a nice conservative play like that, and you're still going to make 30% a year, why not? What the hell else better do you have to do with money? Burns says 4% dividend on IBA. Okay. Anyway, how are we looking overall? Oh, see, isn't that? It's a linky thing of some sort. It's like whenever I put it in one place, it puts it there. So now we're down 100. What's that? 130 points on the Dow, and getting a little bit weaker. But you know, it's to be expected, right? I mean, there's nothing really exciting going on in the market. It's not strong or anything like that. Natural gas took a big tumble. Tesla's doing pretty good. Gold is still up at 1,900. Silver is still up at $24. Copper, where's the dollar? Dollar. Don't have it here. Oh well. DXY. Oh, it doesn't do DXY anymore. Damn it. Dollar. DG. No, not Dollar General. USD. Just USD, right? Oh, that's the other thing. That's the ProShares dollar. That's not the dollar thing. I forgot what the dollar index is. Somebody tell me. I forgot the symbol. Well, nobody knows. Anyway, so you know, look. To me, the market is toppy at best. I just can't really get behind it. You guys know this. I really don't want to get into my reasons for it because I end up doing a depressing webinar. And I want to do a depressing webinar. I'm in a good mood. I won't be in a good mood in 3 weeks if Trump wins, but I'm in a good mood right now. I think we can start the healing process shortly. After, of course, we have people screaming in the streets and fighting and whatever, and statues being toppled all over, and whatever other crap is going to happen. But then we can get back to healing. So over the week, on the weekly view, you know, we're basically boom, we're right back at the all-time highs, and we'll see what happens. But I mean, to me, it's unjustified. How is this weekly? Really, that's a weekly view. We only see 2020. Interesting. So if we go on a monthly view, it's crazy, huh? So here's when Trump took office. And early this year, we were right back where we started. Now we're all the way back at the highs, though, so we have to give it to him. Something good happened at least. In the broader picture, so 2017, right here is where Trump came in, January. And we went from 23 and now we're up to 34, which is a huge gain. I mean, it's a 50% move in the market. Now, of course, Obama came in here in January, in January 2009 at 850, and he handed it off to Trump at 23, which I believe is a 200% increase in the same period. Yet Trump seems to feel that he somehow did a much better job, even though all this momentum all the way to here was clearly from this. Then it became a choppy mess since then. And at the moment, we're up here, but it cost us $4 trillion to get from here to here. So that's a little bit different. And again, it's not so much a political statement as the marking of time. And every country has spent a lot of money with their economies and fighting the virus and so on and so forth. But we've spent more money with less effect than any other country. That's what's scary about it. That's where the problem is. Oh, today I was having fun on the site. I really like it. Visual Capitalist. That's where that chart came from. That chart is scary, by the way. This chart that shows the percent of small businesses open in these various places. 33% closed in Boston, 21% in New York, 24% in Philly, 37% in Washington, 45% New Orleans, minus 45%. Half the businesses, San Francisco, really half, 49%, half the businesses are closed. So, of course, the stock market is doing good. They don't have any competition. They've wiped out Main Street. And if you want to be a conspiracy theorist, don't you think they want that? Don't you think this is great for them, with a capital them in quotes? Because what do they want? They want small businesses wiped out. They don't, Amazon wants to be the only game in town. All these big stores there, you think Macy's is upset that their competition is being, sure. Macy's is having a rough time, but when the recovery comes, they're going to be fighting weakened competitors who can't spend money to compete and can't come up with them. Lord & Taylor's gone. Other retailers are gone. They're going to get much more business moving forward. Even though Amazon took a chunk, they're still the big retail stores who survive are going to have less competition. And even if new competition comes in, it's going to be, it takes a long time for people to get traction. So it's going to be a weak and distributed competition that will not be much threat to the big stores. So the big box stores, the ones that report in the stock market, are all telling you how great things are. Lowe's is great. Home Depot is great. Why? This is how many hardware stores were wiped out. 28% in Seattle, 34% in Portland. Of course, there's different kinds of businesses, but these are scary numbers. 32, 35. This is a consistent number in populated cities. 28, 27, 31, 26, 35, 32, 33. These are horrifying. 34, 32, 30. That's Texas. Things are open in Texas. We're open. Florida's open. 23, 22, 18% down in Florida. 1/4 of our stores are closed. It's crazy. And how do you reconcile that with a robust economy? It makes no sense. But anyway, so what I was talking about was I love this site though. There are so many cool graphs like this. And it's always good to have a different viewpoint for how you're seeing things. So I find this very useful. Lots of cool charts and graphs. I'm not going to get, I don't want to get too into it, but you look at these things, it's like every company in and out of the Dow since 1928, 2 trillion economic, oh, here you go. Here's the 2 trillion, this was an interesting one. The $2 trillion economic drop by sector. So 10% fall in the economy. Despite what they're telling you, here is our GDP last in Q1. Here's our GDP now. So what's the real change in GDP by state? again, minus 34%, 36%, 34%, 30%, 30%, 30%. Everybody's 30%. It's pretty widespread. Nevada got creamed. Tennessee, for whatever reason, got killed also. But I mean, it doesn't matter. 30, basically 30%. It's actually not that useful to chart, except for just to think about conceptually what that means when 30% of your economy goes away. How on earth do you call this a good thing? What is the stock market thinking about? That breaks. See, it's all kinds of cool stuff though. The hardest hit industry by state, and then they always back it up. It's a wonderful. So I really like the site a lot. Visual capitalist. Very nice stuff. Very fun to like read. And look at it. And look how much it is. Technology, money, healthcare, energy, mining. It's just crazy. So very fun. Highly recommended. You know, and this too, though, this is now. This isn't like worst case. This is where we are now. Stimulus package begins right here. Here's what the stimulus package did. It got us from here to here. And since then, here. We've run out of stimulus. You can see it's fattening up a little bit. And if we don't get more stimulus soon, we're going to start going back down into a real recession. You know, but it's just a horrifying number. We talked about that last week. The nature of graphs is such that they adjust themselves to fit your field of vision. But that sort of makes it difficult to gauge what you're really looking at, because when we have a gain of 10% at this point in business revenue, everybody's like, oh my God, this is great. What a good year we're having, blah, blah, blah. Everything's fantastic. This is a sustained drop of 21% now. That was 40-something% for a while. You can't measure that because you have to make up the volume. This volume has to be made up by these at some point to get back to even. Where's that going to happen? How long will you have to have this before you can fill this in? I'd say this total here fills in maybe like around this much. And this is for March, February, and January. So basically this is 1 quarter. And you're using up this, and I'd say you got at least 10 quarters to go of strong growth just to get back to even. And that's why, you know, and the thing is, the Fed is looking at these charts, so they're thinking like this. And and honestly, yeah, this is why you need professionals. Because you hear numbers or you see a chart and you get an opinion, and the guy on TV says this or that, and he's got an opinion. But the reality is, when your job is to work at the Federal Reserve, you're a professional economist, you will see 100 different charts a day. And it starts giving you a better picture. It starts making you think differently. And that's why I get excited when I find cool charts like this. I like to show them to you, because you need to think in these terms. You need to get your head into like, okay, this is another view of what's happening other than these words. You know, because it's old say, oh, the economy's weak, and then, oh, Trump says it's not weak, it's the strongest economy ever, and he said it 55 times, therefore it sounds like it's true. You know, this is what's real. What's real is 30% of the small businesses are still closed. Business revenue is down 21%. So, okay, 30% are closed. Think about the concept. 30% are closed because there's 21% less revenue. Okay, so it's not like 30% closed and the ones that are left have all the revenue that used to be in small businesses. No, it's 30% closed and only 21% and only 10% of that revenue is basically recaptured. The rest is just gone. That revenue's gone. There is no 21% of consumer spending. Consumer spending is what drives this entire economy. And it's down 20%. Now, it's down 20% taken from small businesses. A lot of that went to Amazon. A lot of that went to other companies that took it. Online companies and such have taken a lot of that. Consumers haven't really stopped spending. And as we talked about last week with, I was looking at the retail sales report last week, and we got another retail sales report this week. I know I had it somewhere. Was that for my week ahead? Maybe it was Monday. I remember talking about it. Nope, not this week. Must have been last week. Nope. So let's assume it was last Monday. I definitely remember having a big conversation about this. Oh yes, because I was looking at October, that's why. So click. Oh, it wasn't that long ago. I was thinking, I was thinking that, so Trump had that party the week before this. So it was really right at the end of September. So he had that party and everybody got infected. But on October 5th, he was still in the hospital. And this is what, the 14th. So it's 9 days later. So it's really only like 10 days, 12 days after he got infected. He's still contagious. Either he's still contagious or science is wrong, one of the two. Because everybody says 2 weeks. There it is. I knew I had it. All right. So this might be hard to see, but the bottom line is retail sales down. Well, I mean, oh, I'm sorry, it's not food services. Retail sales overall down 1.8%. So total consumer spending, not off that badly, but the problem is it completely went away from the things that are Main Street. Furniture and home furnishings, 11.3 down. Electronics and appliance stores, 16% down. Building materials, garden equipment, Home Depot, Lowe's, right? 11.4%. People are at home, they're doing crap around the house. Food and beverage stores went up 12%. We're bored, we're sitting at home, we're eating. Gas stations, 16% down. Clothing and clothing accessories, 34%, 35% down. Can you frickin' imagine? 35% down? I mean, you just can't survive that. Non-store retail, so online shopping, up 20%. Food services and drinking places, 20.9%. The problem is, unfortunately, though, this is a huge dislocation away from Main Street. So in other words, what I wrote here on October 5th is reflected in this chart today. This chart today is what happens when you have this data, it causes this chart. Where'd it go? Oh, this chart. Let's try that again. When you have this data, it causes this chart. This is a very simple concept, right? It's exactly what I was talking about 2 weeks ago. I was saying, you've got to understand this is bad. When you see this retail sales report, you talk about it in different ways. You've got to look at things and keep turning them and looking at all the sides. And when you turn the retail sales report, if you look at the headline, you're not learning anything. Now I lost that. When you look at the headline, you're not learning anything. Because the headline says, oh, down 1.8%. You say, oh, that's not bad. But if you look at the actual thing and what happened, you're like, oh my God. There's all these sectors that got totally clobbered, and it was made up for by a couple of sectors. But the dislocation of the change in the economy is what's going to kill you, because those jobs get lost and they're slow to come back. And in theory, and probably in fact, the online sellers are more efficient. They pay lower wages, so you're destroying good wage-paying jobs in favor of minimum wage jobs at remote locations that are not necessarily in your town. So your town's tax base declines while Walmart, Bentonville, Arkansas, and Amazon's fulfillment centers, wherever the hell they are, those places are thriving. They've got jobs, they've got people. But your hometown, Sal's Pizzeria is closed. Joe's Hardware Store closed. Sam's Dry Cleaner closed. Oh, imagine how badly the dry cleaners are getting hit when nobody's wearing clothes. Everybody's got t-shirts and sweatpants on. I mean, that's got to be killer. It's like the Tide Pods are probably doing good. I mean, people are doing the wash more, I guess. But yeah, the repercussions of this thing are terrible. The movie theaters are going bankrupt. AMC's going bankrupt. The other Regal is shut down. They can't reopen. You've got. I don't think that's bad for IMAX though. On the whole, I think on the whole, IMAX is going to be the answer. I think that you're going to see theaters are going to have 2-3 IMAX screens. They're going to start. People are going to come in and buy an AMC. They're going to buy AMC and thing out. They're going to buy out some of these other entertainment screens out. And they're going to turn them into more of an experience type of place, with big screen theaters, more dine-in concepts and things like that. They're going to go for more of that, where it's more spaced out and people aren't on top of each other like they are on a regular movie, so people pay more. Like iPick, if you guys have iPick, I have iPick with my town. iPick is really nice movie theater dine-in, but very expensive. It costs you. The tickets are like $20 and the food, well, the food's good though. I wouldn't complain about the food. It's like going out to a decent restaurant. There's my iPick. I picked Del Rey. Let's see if we can do images. So yeah, you see how oh, that's not how an iPick. Wow, that's weird. I've never been in one that looked like that. That's not at all what I was trying to show you. This is kind of how our iPick basically looks, like this. See how that is? Everybody's got their own little pods, and you just sit there with your friend or whoever you're with, and you just you share your tray table, and they come and they bring you food, and that's your stuff, and you just lay down and you watch the movie. It's totally great. It's way too, and the food is the food's good. It's like gourmet food. Where was it? Oh, there you go. That's the picture. So it's pretty good stuff. That's like a sushi thing that they got there, and there's a really good fries and these nice burgers and whatever. It's all good, crab sandwich or a lobster, whatever the hell it is, lobster roll. It's good. So you go there, I mean, you'll spend like, $150 or something like that. Oh, see, bankrupt. But they're chugging along. But I'm saying, even, obviously they unfortunately began their theater concept at the worst possible time, because they just built out a whole bunch of theaters and then the thing got hit. So I'm sure they had to reorganize themselves, but they're still going right now. But I think this is the future of movies. I think you're going to be this far. I think that's what you're going to see. See how everybody's basically spaced out pretty good, and you're just having a much more expensive per seat experience. So these guys are making the money. Instead of selling all these tickets, they're selling $20 seats, and they're selling another $100 worth of food for these people. This is their dinner for the night. It's like a restaurant that happens to show movies. So I think you're going to see more of that. I think IMAX is going to go this way too. You're going to have this big screen theater and a whole experience and whatever. But things will change, and they'll change long term. When the Great Depression ended, people didn't run out and start spending money like crazy, right? It takes many, many years for when people suffer this kind of economic pain. It takes a long time for the spending habits to go back. And we went from the Roaring 20s, right, which was a huge time of economic expansion, and everything was great in America and so on and so forth. We went from that right into the Depression. Then we went from the Depression to World War II, and literally it was from 1930 until the 1950s we were in effectively a recession. And it was only the massive spending, the massive deficit spending of World War II that brought us out of the Depression in the end. World War II, or I'm sorry, so Great Depression, no, World War II, that's what I meant. World War II deficit spending. See if we can get a good shot of that. Yeah, so public debt as a percentage of GDP. Okay, so public debt in the Great Depression. So we went like this. This is a New Deal. This is Roosevelt coming in with a New Deal, bringing your debt up to this. World War II, though, that's when we went crazy. And that's what we're doing now with the virus. We're way up here. We're past 110%. We're at $27 trillion of debt. And we came back from that eventually. Here's another one. That's not very big. But see, we peaked out here at 110%. But now, if you look at the national debt clock, I know that's going too fast to the screen, but there we are, $27 trillion. All right, and I'll show you something. The worst thing about this debt clock is here. Speaking of, again, do we have a good economy? Well, if we had a good economy, would this number be going backwards? Federal tax revenue, 80, 79, 77, 76, 75. We are losing tax revenue. It is ticking backwards, not forwards. That's not a good economy, guys. We're only collecting $3 trillion, but we're spending $6.2 trillion this year, and that's only the official number. It's really a lot more than that. So we're gonna end the year with a $4 trillion debt for this year alone. $27 trillion, and our GDP is right now about 19 something. So we're 8 trillion over 19. That's 150% in debt. All right, and I talked about that earlier in the week too. But look at this. I don't know how well you guys can see this stuff when it's moving, because I'm sure there's a delay in the thing. But these are going backwards: 72, 71, 70, 69. Okay, this is going down, which causes this to go up even faster because there's less revenue coming in to pay off this. And this is insane. Okay, we are way into insane territory at this moment. And it's not stopping, it's not slowing down. And how are you going to fix it? Okay, payroll tax revenue is $1 trillion. Income tax revenue, the revenue you pay now, only contributes $1.5 trillion to the entire GDP, to the debt. So if we doubled income tax, doubled it, we would not put a dent in this deficit. It would only catch up half of that deficit. We would still be running a $1.5 trillion deficit if we doubled income taxes. Here's Trump's tariffs, $65 billion. That's not going to help. Corporate taxes, that's a joke, $174 billion in corporate taxes. That's not going to help either. You could double that and it still isn't going to help. So if we doubled all this, we would still be, well, this year, but I mean, in a normal year, we'd have to basically double taxes, all taxes, to get caught up. So it's either that or we cut government spending by 100%. So either 100% more taxes or 100% less government spending, or we can do 50% less government spending and 50% more taxes, which means you'll be living in a country where you're taxed to all hell's creation and government services are cut by 50%. See that? So that brings us to best countries to live in. Not us. Oh, that's horrible. How far down the list are we? Does the list go down this far? Oh, wait. US. I don't know. Where are we? How do we figure this out? We don't make the list. How embarrassing. How is that amazing, huh? Norway, high taxes. Switzerland, not high taxes. Australia, no taxes. See, it's an interesting mix, right? Ireland, no taxes. Germany, high taxes. Iceland, I don't know what the hell Iceland does, frankly. Wow, look at that. I like Iceland. I would live in Iceland if it had like more people. Sweden, very high tax. See, very socialist, very socialist. Obviously more socialist list. Hong Kong, interestingly, still on the list. Singapore, wonderful place. Netherlands, someplace I would like to live myself. I love, all right, that's see, I could really talk to the Netherlands. I would like to live in Amsterdam. I love that place. So honestly, guys, we're not even on the list. And at some point, you got to really start thinking about this. All right, as you guys know, Jersey, some of you may know, I have my retirement spot picked out. I'm going to Jersey, and not New Jersey, this Jersey. This little island right there off the coast of France, right over there. That's my spot. It's a British protectorate. It's a beautiful island. It's very farmy, but it's got all like it's like an English village. It's not big, but it's got an airport, so you can zip over to Paris very easily. And then once you're in Paris, obviously you can go anywhere you want. You can go to Paris, you can go to London in like a half-hour flight. It's like no big deal at all. And so, you know, so when you want to communicate or be part of the world, you can. It's a huge financial center. It's for a lot of people in tax exile over there. And they've got their own laws. They're not really part of England, but they are a British protectorate. So, yeah, so you're not part of the European Union. You're not part of England. They just got their own little thing going on. It's really worth checking out. You do need quite a lot of money to live there. Which is not to be, you know, snobby, but I mean that's like one of the advantages of it is you can't just go there. And it's a beautiful place. It really is just really nice. My grandparents used to go there on vacation, so that's how I knew about it. And I've always liked it. I've always thought it was a wonderful place. It's an old place, and it's just a lot of financial people live there. It's a good, active community. And like I said, I mean, and again, I'm too young to be there now, but my plan 10 years from now, when I start slowing down, is I'm like, that'll be fine for me. Take a walk, go to the pub, you know, hang out with my friends, chat in the pub, you know, hang out there. And then when I feel like going to Europe, I want to take a weekend trip or whatever, I hop on a plane and I'm there in a half hour or so. And then I can go wherever I want in the world. So, but you got to think about somewhere you want to be that maybe isn't here. I mean, seriously, this is a problem. Wherever it went. Where was it, that clock? I lost it now. Well, whatever. Anyway, this debt thing is a problem. It's a problem we may not be able to extricate ourselves from. And this virus thing is pushing it over the edge, and our lack of response is really pushing it over the edge. So again, see, this is the problem. I start talking about that and it gets gloomy. So I don't want to be gloomy. I'm trying so hard not to be gloomy, but 10/7, so this is a week ago. So let's see what the numbers are. We did this later. This is smart last week. So we got 36 million infected plus 7.5 million in the US. And we've got 1.05 infected, dead in the world, and 212 in America. All right, so now we'll refresh and see how we're doing in the last week. Dun, 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 dun. So what's happened in the last week? We went from 36, so we got 2 million more people in the world. 2 million in 1 week. 2 million in 1 week is getting, it's 6%, 6.6% more people in a week. That's not a good growth rate. So 2 million more people in 1 week have been infected. That's number one. In the United States, almost 4 million more people. So we take, oh, I can't erase it. All right, anyway, so it's went from 7.5 to 7.9. So not 4, I'm sorry, 4, so 400,000 more people is 5% more people in America got infected. Right? It's more than 500,000, 5%. Global deaths have gone from 105 to 108, so 30,000 more people died globally, and 4,000 of those people were in America. We went from 212 to 216. But that's good. Our death rate's slowing down. It's not 1,000 people a day anymore. That's more like 500 people a day or 600 people a day. So there's the good news. Only 4,000 some odd people died last week in the U.S. But this is really concerning. And I was talking to a friend of mine in England today, and he was surprised that they've jumped up in their infection rate so much that they've got 10,000 people a day being infected or something like that. And the reason for that, though, and we by the way, we're talking 50,000 a day in the U.S. We're averaging 50,000 people a day getting infected. 50,000. The total in China ever is like 85, 90,000. We're getting 50,000 per day in the U.S. And I said to him, I said, the reason is, and we've discussed this before, I said, the reason is because if you don't have it under control, we started with a base in February of 60. What are these numbers? No. 2520, 3.745. Oh, well. Oh, that's globally. I'm sorry, that's not the US. Anyway, so we started with a base in March in the US of 15 people infected. And that turns into 7.8 million. You're now starting with a base of millions of people infected. Every time you're starting with a base. And if you don't actively contain the base, they will all spread the same way the first 15 people spread. Every single one you miss will spread like that. So when you have, see, this is your recoveries. It's hard to do on a state level. Let's say, for example, in New York, let's say New York is 5% of all cases in the US. They would be 350,000 total cases, okay? Out of 350,000 cases in New York, 100,000 outcomes. That means 250,000 people have undetermined outcomes so far. They haven't resolved. Why is that? Because most of the cases, the vast majority of the cases have occurred in the last month or so, last couple of months. Most of the cases have occurred here. Look at the area of this compared to the area of this. So I would say that's 4 times. If you take this section here, right? Basically, that is 4 times, right? 4 of these would be this section here, July, August, September, 3 months. So in the first 3 months or 4 or whatever, You had 1/4 as many people being infected as you've had in the last couple of months, in the last few months. In this, look at this section, look at September, and we're only into the beginning of October. In the month of September, again, think of the area. The month of September has more people that were infected in the entire first quarter. Almost twice as many people have been infected in the last month than were infected in the first 3 months. That's why it's always surprising how fast it grows. If 15 people can cause this, and you've got 200,000 people now who are actively infected, if 15 of those people are allowed to interact the way those 15 people were back here because we weren't careful enough, if 15 people slip through the cracks, just those 15 out of 200,000 currently infected people can cause another 7 million infections. We already know that. It's a fact. This is what happens when 15 people mingle. 15 people mingling causes this. We have 250,000 people out there infected, and how many of them aren't being careful? How many of them are running around in mega hats and holding group meetings and shouting and spitting on people? It only takes 15 more of those people to double our rate of infection. If there's 150 of those people, we're going to have 10 times the rate of infection. If 150 people out of 250,000 currently actively infected people are out there with their mega hats, walking around in crowds and not being careful, then we could have 10 times more people infected, and that would be effectively half the population. And that is happening because our government is not cracking down like other governments, because our government is not enforcing any kind of containment like other governments. And the UK is in the same boat. They're not being cautious enough. And it's a problem in all the Western democracies. We're not cautious enough. We're not taking it seriously enough, and we're not doing enough about it. And because we're not, we're going to face the consequences are inevitable. You know, we're not leaving it to chance. There is no chance. You know, it's like putting water on a flame and saying, I'm leaving it to chance, it'll either boil or it won't. It's like, no, science says it will boil. It's not chance, it's a fact. If you put a pot of water on top of a flame, the water will boil. You don't come back 2 weeks later and say, oh my God, look at that, the water's gone. I wonder what could have happened. Again, science tells you what happened. The water boiled out and evaporated, probably the pot cracks at a certain point. You know, we've all done that, right? We've all left water boiling in a pot on the stove and it got broken. You know, it's not a mystery to people who pay attention to facts. This is what happens when you don't do it. That's why Fauci is so pissed off. That's why all these scientists are pissed off. They're like, it's not an opinion, it's a fact. And we're ignoring the facts. And again, this is why I'm telling you guys, this election is life and death. We can't live like this. So certainly a million of us, 2 million of us can't. They will die. That's what this election's about. We are currently killing 1 million plus people. They're just not dead yet. But they're going to be, because there are 10,000 of these 15s running around. 10,000. The same people who are going to vote for Trump are going to be running around and infecting other people and acting like this is not a real thing. And if he wins the election, do you think it's going to be better or worse? Okay? Joe Biden is going to take away your freedom. Joe Biden is going to say, we have a national emergency. You will wear your freaking mask. People are going to be careful. The following businesses will not be open for the duration, and we will give them money and tell them to just have a nice vacation, come back when we get the thing under control, because it's not under control. And you know who did that? These guys. Look at the map. That's what these guys did in these countries, Asia, because they don't care. They do not, you know, you can say, oh, they violate human rights, blah, blah, blah. They did what you have to do to stop this thing, and they did. Modi did not. His country is a disaster. We did not. Europe, spotty enforcement. Westerners do not like to be told what to do. And Europe is still very bad. India, disaster. Possibly a total collapse of their economy is heading their way. South America, not any better than us, really. Terrible, terrible. It's a big problem. And the market is basically ignoring it. And again, it's not an opinion. This is science. This is what's going to happen. I don't know what people think is going to happen that's going to cause this to turn into this. Not when this only represents 4%, 2.5% of the population. There's 330 million people in this country, and we only have 7.8 million infected. Probably 10% have been exposed. So there's an X amount that's immune, effectively don't really show symptoms. That's good. Okay, so luckily 10% of the people are immune, but when it doesn't matter, because we're still going to get up to numbers where you're going to have this number be more like 50 million, 70 million, whatever the number is, and these numbers are going to go up 10 times, 5 to 10 times. And that's going to cause sweeping, widespread economic damage. The healthcare system, the financial system, these business closings are not going to go away. And that's why we're trying to be careful. That's why the hedging is so important. If you want to play the market, I'm not saying don't play the market because the stimulus is being thrown into it. You know, why would you not play? But you've got to be hedged. You can't just keep playing and act like nothing bad because it's going to happen, because we're in a very, very tight situation. All right, so where are we? DX, thanks. Okay. No, not DX. Shit, which is the one I use? Hang on a second. On my other screen. Da, da, da. Oh, it is DXY. Shit, it's got a dollar sign. That's why it doesn't work. There we go. Although that's broken too, isn't it? But at least you know what the number is. 9336. What else? Da, 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 da. Have the following Roku trades. SK saying, have the following Roku trades, blah, blah, blah. It's now worth, in one of your comments, you talked about protecting gains. So they have 20%. Should I do anything now? All right, let's talk about that in chat, all right? Because that's like a very specialized thing, so it's not really worth having a big discussion about it here. But we'll take a look at that trade properly when we have the regular chat. Oil's back at 41 again. Again, the second time up, it's not as easy to short, though, unfortunately. So we're going to stay away from it now. And Robin says, I have XRT, January bear put spread. I keep expecting something to happen, but so far, no retreat. Do I roll up and out or just up? Yeah, look, retail, again, they've been bailouts. And the question is, you got to look on an ETF like XRT, you've got to look at the individual components. Just don't say because it's retail. So XRT is a retail spider ETF, but so you don't just say, oh, retail bad, therefore I should short it. The question is, who are you shorting? And with every ETF, you've got to look at it this way. So XRT, you know, XRT has been propped up with everything else that came up. It came back. It's at highs. That's crazy. How is retail highs? But keep in mind that overall retail number is actually pretty good. It's just that there's a dislocation. But the question is, who are the components in XRT? Are they the ones that are good or the ones that are bad? So you look in holdings and say, who am I really investing in? Well, the problem is that you've got overstock. Overstock is the largest holding in retail holdings. Why? Because overstock went flying higher. It didn't start out that way, but it took over. OSTK. And by the way, this is the value of being diversified, because the XRT is a very diversified base. So overstock is much higher than it was. It has now become the largest holding in XRT, because XRT is not a heavily weighted portfolio. All of them are very small. In other ETFs, you have a couple of dominant players. These guys aren't very dominant. They're 1.8, 1.7. So in other words, the good ones rose to the top. Overstock, Etsy's doing very well. It's an online seller. Rite Aid, I don't know what the deal is with Rite Aid anymore. Why are they so good? That's weird. Right, man, they're not good. They're chugging along, but for some reason, the XRT has a big piece of Rite Aid. Big Lots, see another one, like Overstock doing well. Grocery Outlet Holding Corp, you know, that's weird, isn't it, right? The Gap, Lilith Motors, Camping World, Grubhub, Best Buy. So the only actual retailer, the only retailers that are here is Gap and Best Buy, the only Main Street retailers. So if your premise is looking for the Main Street retailers, they're not represented by XRT. I mean, I'm sure in the next 20 or 30 holdings they are, but they're very small. They would obviously be very small and insignificant in it. This is only 15% of the assets. So you've got a very diversified ETF where some parts of retail, just exactly what we saw on that retail sales report, if it's still up. There you go. So on the whole, you're only down 1.8%, and some sections like building supplies, like online retailers, non-store retailers, are doing very well. Others are doing badly, but what turns out is because XRT is a very diversified ETF, then what happens is that the ones that are doing well rise to the top, and depending on how the ETF is structured, they may have outpaced, their gains may have outpaced the losses of the other guys. So it's not like it's a sure thing. You're thinking in terms of retail has to go down, but this ETF is not what you think it is. That's why we haven't been shorting it. In the last crisis, we shorted XRT because it was much more correlated to consumer spending at the time. Now it is not. Now you're sort of all over the place. And honestly, I don't know what Grocery Outlet Holding even does. I don't follow these guys. Big Lots, we know. Big Lots and Overstock are the same concept, basically. They're doing well because people are buying that kind of stuff. Etsy is the crafts online. Rite Aid Pharmacy, they're not doing too good, but they're not doing too terrible either. Gap is Gap, but I bet they're doing good mail order business on the whole. Well, let's take a look at Gap, GPS. I mean, Gap is exactly the kind of clothing we are wearing, right? So yeah, they're not doing great, but they're not doing terrible. See, these guys are a lot of consumer cyclical, apparently. But anyway, so these are not the businesses that you're betting against. That's the thing. So it's not a question of just double down. So that you have to think about the fact that your premise may be flawed, and it should not be a bet that you're into. Also, you're very, very aggressive with the 50-35 spread. Is very aggressive because you anticipated a very large drop, like a 30% drop from 50. Why would you sell the 35 puts if it's not going to go that low? I always would rather be in the money and sell a spread like the 60-50 spread. I'd rather sell that and say, I don't think it's going to go higher. But in either case, though, I would not have played this at all because I don't see that there's a real correlation to what's going on. And not only that, though, but stimulus, 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 right? It's not the best bet to bet against that. So speaking of balancing portfolios, let's say I got to wrap this up very shortly. I got a meeting. Short-term portfolio dropped a lot, down 302%, because obviously Tesla killed us again, as usual. Still $400,000, not awful, but we dropped like 60,000 bucks from yesterday. All right, and that's where Tesla is. But this does not reflect the changes we made yesterday, but none of them are particularly beneficial. We got a little bit more aggressive with our hedging here, so we'll see what the new numbers look like. The long-term portfolio, though, 110%. So that's up at 105. So this plus 400,000 is 1.45. So our high was 1.5, and we're a little bit below the high for the combined portfolios. But very respectable. It's 110% up for the year. We started on we actually started on October 1st of 2019. So it is actually the 1-year anniversary now of this thing officially. And we started with $500,000. Now we have over $1 million. So we're up 110%. Very nice. And there's nothing, you know, these are all good positions. And again, it's diversity. We just added Goldman Sachs today. Harmony, Coca-Cola, Micron, Milam, Berkshire Hathaway, Caterpillar. Okay, notice we don't even repeat sectors, right? Plains Pipeline, Broadcom, Berkshire Hathaway. Berkshire's a proxy for the S&P. Cisco, FL, Gilead, GM, IMAX. I mean, there's some really good diversity here. Intel, Labus, biotech ETF, Macy's, Middleby is ovens. They exploded high. They're way over. I go the marijuana ETF, 3M, Philip Morris, or Altria, whichever one that one's Altria. Restoration Hardware. Again, that's home. That turns out to be home goods. That worked out great for us because that's very popular. Look at that. We played 85 125 spread, and they're at 391. I think we were a little bit too conservative on that one, possibly. SKT is my mole REIT that I love that nobody else loves. Shearing Plow is good. SunPower, of course, was a huge home run. AT&T, Textron, Walgreens. So, you know, total diversification, but that's why it works. We're picking different things in different sectors, but we're also picking the most undervalued part of every sector. So the whole portfolio is designed to be effectively bulletproof. And we don't swing for the fences. We take very conservative positions. I mean, look at where we are here. The 170, 190 spread, they're at 210. The 100, 120 spread, they're at 163. This thing is buried. Plains, we sold the $5 calls, they're at $7. Broadcom, the 200, 320 spread, they're at 381. Berkshire, 150, 200 spread, they're at 210. Cisco, 35.50, and they're at 40. That one's actually not, you know, in the range still. These guys are where 25.37. They're right at the top at 38. Gilead also right at the top of the range. GM way over. IMAX is underperforming. Intel over the range already. They only just took those guys. Labus double where we were. Macy's in the range. Middleby over the range already. So every play we take is very conservative, in the money or near the money, and we set low targets. We don't set high targets. You know, if they do too well, we cash them in early and we find something else that's a good value. But you know, look how well we rode this thing out over this period with these positions. We added a little bit when they went down. We changed the positions. In fact, we were talking about that with scaling in. A lot of these positions are very small. You know, when you see that we've only sold 5 of something or whatever, or a few puts. See, these guys, we didn't sell puts at all, or we took them out. Here we sold 10 puts, 5 puts. Depends on the position size too, though. 10 puts here. You know, when you see that we only sold 10 puts, it means it went up probably straight away, and we never doubled down. 10 puts, and this is a low cost 10 puts, so you know that was an initial entry. 5 puts, 5 puts. When you see that we only sold a few puts like that, that means that was our first trade, and it went up since then, and we never bothered again. The ones where we sell a lot of puts, like SunPower, and a lot of positions, when you see 80, 80, 40, you know we double down on that. We don't start out with 80, 80, 40. So when it got cheaper, we doubled down on it. This one too, 75, 75, 25. AT&T, we doubled down on at some point because it got cheaper. It's still cheap, frankly. You know, that's where we're scaling in. Now we scale in and we add more when something gets cheaper. But if something doesn't get cheaper and it just takes off straight away and goes up and up like Restoration Hardware did, then we just never, that's it. The initial position becomes the only position and we let it go. You don't have to keep working on a trade. You don't have to keep playing with a trade. If it does well, you say, fine, that did well. Now we made our money. Restoration Hardware in April, so we'll be able to see it on the chart. Let's see. Not that one. RH. So we bought, why did we buy Restoration Hardware? I always like Restoration Hardware, but we didn't buy it here because it was $250.